fraud, error, and misstatements caused by fraud. Learning objectives. What is a fraud? Misstatements caused by fraud. Responsibility for the prevention and detection of fraud. Auditor's approach for detection of fraudulent financial statements. What is fraud? As we know, fraud is wrongful deception intended to result in financial or personal gain. In business environment, it is an intentional act by one or more individuals among the management, employees, or third parties. It involves the use of deception to obtain an unjust or illegal advantage. A fraud may be committed by an individual, or in collusion with people internal or external to the business. Misstatements caused by fraud. Auditors are concerned with two types of misstatements caused by fraud. The first one is misstatements resulting from fraudulent financial reporting. Fraudsters manipulate financial statements by misrepresenting actual position. For example, they may show inflated revenue. The second type of misstatements, resulting from misappropriation of assets. Fraudsters siphon off assets. They may steal cash using fictitious payments, or inventory for personal use, or sale. Responsibility for the prevention and detection of fraud. Managements have to focus on fraud prevention within the organization. They have to put in place proper systems to prevent frauds, and establish a strong control environment. They have to nurture a culture of honesty and ethical behavior. The primary responsibility rests both with those charged with governance of the entity and with management. In the UK, the auditor has to comply with additional responsibilities under law for prevention and detection of fraud. They also have to satisfy relevant ethical requirements regarding non-compliance with laws and regulations, including fraud, which may go beyond the auditing standards. Hence, the auditor should obtain reasonable assurance that the financial statements are free from material misstatement. Specific objectives for achieving this reasonable assurance are: to identify and assess the risks of material misstatement due to fraud, to obtain sufficient and appropriate evidence regarding the assessed risks of material misstatement due to fraud. This can be achieved by designing and implementing appropriate responses, and to respond appropriately to fraud or suspected fraud identified during the audit. Audit approach. Auditors must always be alert about the possibility of misstatements resulting from both fraudulent financial reporting and also misappropriation of assets. The misstatement may be intentional, that is fraud, or by oversight, that is error. Members of the audit engagement team should discuss the susceptibility of the financial statements to material misstatement due to fraud. Hence, it is important for auditors to have a mindset of professional skepticism that the management who have always appeared honest may not really be. The auditor should obtain an understanding of how those charged with governance exercise their oversight of management's processes for identifying and responding to the risks of fraud. The auditor should also check how the internal control process mitigate risks of fraud. The auditor should also check how the internal control process mitigate risks of fraud. Auditor should check how management's processes for identifying and responding to the risks of fraud are communicated. These communications are key to both those charged with governance and also to the staff. They must also inquire about management's assessment of the risk that the financial statements may be materially misstated due to fraud. The auditor should also inquire about any actual, suspected, or alleged fraud affecting the organization, including discussions about fraud with internal audit team. In determining an approach to fraud, auditors must consider the following conditions that lead to fraud: motivation, that is an incentive or pressure to commit fraud; opportunity, that is a perceived opportunity to commit fraud; dishonesty, that is an ability or attitude to rationalize the fraudulent action. Similarly, the auditor may have to amend the nature, timing, or extent of plan audit. Procedures to address assessed risks of material misstatement due to fraud at the assertion level. The auditor shall perform the following functions to determine overall responses to address the assessed risks of material misstatement due to fraud at the financial statement level. Consider the assignment and supervision of personnel. Consider the selection and application of accounting policies used by the entity. Incorporate an element of unpredictability in the selection of the nature, timing, and extent of audit procedures. In this video we learned about fraud and its implication on veracity of financial statements of an organization. It also explained how an auditor can prevent misstatements. It also underlined responsibility of auditors in this regard to investigate and identify fraudulent financial statements.